One morning, the world woke up, and it wasn't the same. October 19th, 1987. Billions of dollars just evaporated in a single day. No one fired a bullet, no one shouted, but everyone's sold. The phones were jammed, the computers were in control. Panic didn't spread from person to person, it spread from machine to machine. And on that day, the world learned a terrifying lesson. Markets aren't run by numbers, they're run by fear. This is Black Monday, and in this explainer, we're going to break down how the panic of that single day was stopped. So, to really get your head around the crash, you first have to understand the party that was raging right before it. The mid-1980s, it was a time of just incredible optimism. The economy was absolutely booming, confidence was through the roof, and on Wall Street, it really truly felt like the party would never, ever end. And you could see this optimism in the numbers, big time. Starting in '82, the Dow Jones just started this relentless, historic climb. By early 1987, it had nearly tripled in just 5 years. Can you imagine? People felt rich, the headlines were all screaming about a new era of prosperity, and a really powerful and, frankly, dangerous belief was starting to take hold. See, this one sentence pretty much defined the whole era on Wall Street. The thinking was, that the system was now so sophisticated, so well managed, that a crash like the one in 1929 was basically impossible. This created this bubble of invincibility. But behind the scenes, a brand new player had just entered the game, one that was about to change all the rules. And that brings us to the ghost in the machine. While all the traders were celebrating on the floor, the real revolution was happening quietly inside computer servers. This was the critical factor, the thing that made 1987 completely different from any crash that came before it, the rise of algorithmic trading. So the main strategy was called program trading, and the idea behind it was honestly deceptively simple. You just code computers to automatically sell off these huge blocks of stock if the market drops past a certain point. It was even sold under this really reassuring name, portfolio insurance. The whole idea was to protect investors from big losses. In theory, anyway. But here's the thing. There was a massive, fatal flaw in this logic. A question that, it seems like nobody was really asking. What happens when thousands of these insurance programs all try to sprint for the exact same exit door at the exact same time? Well, on October 19th, 1987, the world found out. It all started pretty quietly. Before the U.S. markets even opened for the day, markets over in Asia and Europe were already deep in the red. So by the time that opening bell finally rang on Wall Street, the mood was tense. The first few sales started, a little dip here and there, and then the machines took over. This was the exact moment the avalanche began. As prices dipped, the first automated portfolio insurance programs kicked in, selling massive blocks of stock. Well, what does that do? It pushes prices down even further, which in turn triggered the next wave of algorithms to start selling. It was a vicious, self-perpetuating feedback loop, and human control was officially lost. The scene on the trading floor was just absolute chaos. Brokers trying to make trades found the phone lines were totally jammed. The ticker tape that shows stock prices, it couldn't even keep up with what was happening in reality. For some stocks, there were literally no buyers at any price. The market wasn't really a market anymore. It was a one-way fire escape, and the machines were pushing everyone out the door at once. When the closing bell finally, mercifully rang, the damage was just staggering. The Dow Jones had fallen 22.6% in a single day. To this day, that is still the largest one-day percentage drop in the index's entire history. It was even bigger than the worst day of the 1929 crash. But the real danger here wasn't just the number. It was the complete and total evaporation of confidence. As one journalist who was there put it, all that was left was the free fall. Trust in the entire system had vanished. The panic was now psychological, and that was a whole different kind of problem to solve. The world was absolutely bracing for a second Great Depression, but this time, something different happened. The story now pivots from a technological failure to a psychological rescue, and it was all led by a man who had only been on the job for 2 months. So what was the key difference? It all came down to the response. Back in 1929, the people in charge were silent. They were indecisive. They let banks fail, which led straight into the Great Depression. But in 1987, the new Federal Reserve Chairman, a guy named Alan Greenspan, he chose a very different path. He didn't stay silent. He spoke. This is it. This is the sentence that changed everything. I know, it sounds simple, right? Maybe even a little bureaucratic, but its impact was absolutely monumental. It was a short, clear, powerful message sent to every single bank, trader, and investor on the planet. Look, this wasn't just about money. It was pure psychology. By promising liquidity, the Fed was basically saying, hey, we will lend banks all the cash they need. No one is going to fail. That single promise restored confidence. See, panic thrives on that terrifying feeling that you're on your own. The Fed's message was simple and incredibly powerful. You are not alone. And just like that, the freefall was stopped. But, of course, the story doesn't end there. The rescue was a huge success, but it came with a long-term cost. By stepping in so decisively, the Federal Reserve created a powerful new precedent, one that would end up shaping the markets for decades to come. So this whole situation created something economists have a term for, moral hazard. And it's actually a pretty simple idea when you think about it. If you know that someone is always going to be there to bail you out, you're just more likely to take bigger risks. And the market learned a powerful lesson that day. When things get really bad, the Fed will step in and provide a safety net. And with that, a new pattern was set. After 1987, an expectation was born. You saw it through the dot-com bust, you saw it in the 2008 financial crisis, and you saw it again with the 2020 pandemic shock. The market just came to expect a rescue. This belief in a central bank safety net, it became known as the Greenspan put, and it would change investor behavior forever. So, this is the really complex legacy of Black Monday, isn't it? On one hand, the immediate panic was stopped, and a global depression was prevented. That's a massive success. But the side effect was that the market safety net, which used to be invisible, was now right there in plain sight. And the expectation of a rescue became a permanent feature of our financial world. And that leaves us with one final and, I think, critical question for today. The actions taken after Black Monday were probably necessary to stop a catastrophe. But in doing so, did we accidentally create a system that now depends on these rescues? A system that takes bigger and bigger risks, completely confident that it will never be allowed to truly fail. So that's the story of Black Monday, a day the machines took control, and a single sentence brought the entire world back from the brink. If you found this useful, don't forget to like and follow for more videos.